Big opportunities in life have to be seized.
Imagine waking up one morning, not to the sound of an alarm, but because you've built a life where your money works for you, even while you sleep. Sounds like a dream, right? But what if I told you this could be your reality thanks to something called dividends? By the end of this video, you'll learn how to earn $5,400 every single month without trading your time for money. So what exactly are dividends? In simple terms, dividends are payments that companies make to their shareholders from their profits. When you own shares of a company, you become a part owner. And just like any business owner, you get a share of the profits. It's like getting a paycheck just for holding onto your stocks. Why are dividends so powerful? Let's look at some facts. In 2020, companies in the S&P 500 paid out over $58 billion in dividends every single month. That's billions going straight into the pockets of investors. And here's the kicker. You don't need to be rich to start benefiting from dividends. Even a small investment can grow over time and start generating steady income.
If you are intrigued so far, hit that subscribe button and ring the bell to get notified so you don't miss out. Let's dive back in.
But here's where most people get it wrong. They think investing is all about buying low and selling high. This approach is risky and stressful, and many end up losing money. Dividends, on the other hand, provide a reliable income stream, regardless of what the stock market is doing. And when you reinvest your dividends, meaning you use the money you earn to buy more shares, you start to see even greater returns. This is what experts call compounding, and it's one of the most powerful forces in building wealth. Imagine this. You start with just $100 invested in dividend-paying stocks. You reinvest every dividend you earn, and as time goes on, your investments start to grow exponentially. Over the years, what started as a small amount turns into a significant income source. This is why so many successful investors like Warren Buffett love dividends.
I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock.
They understand that it's not just about the stock price going up. It's about creating a steady stream of cash flow that grows over time. In this video, we're going to break down how you can use dividends to create a monthly income of $5,400. Yes, you heard that right, $5,400 every single month. I'll show you the steps, from picking the right stocks to setting up your portfolio. By the end, you'll have a clear plan to start building your own dividend income stream. But first, let me share a crucial tip that most people overlook. Most investors focus only on high dividend yields, thinking that the higher the yield, the better the investment. But that's not always true. A high yield can sometimes be a red flag, signaling that the company is struggling financially and may not be able to sustain those payments. Instead, look for companies with a strong track record of paying and increasing their dividends over time. This indicates that the company is financially stable and committed to rewarding its shareholders.
We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business.
I'm going to reveal how to choose the best dividend-paying stocks and set up a portfolio that will help you reach your goal. So don't go anywhere. You're about to learn the exact strategy to turn your investments into a reliable income source. Now that you understand the power of dividends, let's dive into building a strong portfolio that can pay you $5,400 every month. But before we get started, I need to highlight a common mistake that many new investors make, focusing only on high-yield stocks. It's tempting to choose stocks with the highest dividends, but this can be a trap. High yields can sometimes indicate that the company is struggling and might not be able to maintain those payments. So how do you choose the right stocks? Start by looking for companies with a history of paying and increasing dividends consistently. These are often found in sectors like consumer staples, healthcare, and utilities. For example, companies like Johnson & Johnson and Procter & Gamble have been increasing their dividends for decades. They are stable, well-established, and have a strong commitment to rewarding their shareholders. But just choosing the right stocks isn't enough. You need to diversify your portfolio. This means spreading your investments across different sectors and industries. Why is this important? Because diversification helps protect your income if one sector takes a hit. For instance, if the tech sector faces a downturn, your investments in healthcare or consumer goods can help balance the loss. Let's break it down step by step. Select reliable dividend stocks. Look for companies with a proven track record of paying and growing dividends. Check their dividend yield, payout ratio, and history of dividend increases. A good rule of thumb is to choose stocks with a yield between 2% and 5% and a payout ratio below 60%. This balance indicates that the company is generating enough profit to cover its dividends and has room to grow. Diversify across sectors. Don't put all your eggs in one basket. Spread your investments across different industries like technology, healthcare, utilities, and consumer goods. This reduces the risk of losing income if a particular sector underperforms. For example, you could choose a mix of tech companies like Microsoft, consumer staples like Coca-Cola, and healthcare stocks like Pfizer. Reinvest your dividends.
We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it.
This is where the magic of compounding comes into play. By reinvesting your dividends, you're using the income you earn to buy more shares, which in turn generate more dividends. Over time, this creates a snowball effect, growing your portfolio faster than you'd expect. Most brokerages offer a dividend reinvestment plan, DRIP, that automatically reinvests your dividends so you can set it up and let your investments grow on autopilot. Monitor and adjust your portfolio. Building a dividend portfolio isn't a set-it-and-forget-it strategy. You need to regularly check your investments to ensure they're still performing well. Companies can change, and what was a great investment last year might not be this year. Keep an eye on the company's financial health, changes in dividend policy, and overall market trends. If needed, adjust your portfolio to stay on track with your financial goals. Now let's talk numbers. To generate $5,400 per month, you'll need a well-thought-out strategy. For example, if you invest in stocks with an average dividend yield of 4%, you'd need a portfolio worth around $1,620,000. That might sound intimidating, but don't worry. By starting small and reinvesting your dividends, you can reach this goal faster than you think. Remember, the key to success is patience and consistency. You won't see massive results overnight, but by following this strategy, you'll be building a solid foundation for long-term financial freedom. And if you're feeling overwhelmed, don't be. Just take it one step at a time. Start with a few reliable dividend stocks. Set up your DRIP and watch your portfolio grow. I'm going to share a special type of dividend stock that can accelerate your journey even more. This strategy is often overlooked, but it can have a huge impact on your monthly income. So stay tuned. You're about to discover one of the best-kept secrets in dividend investing. Now that you've learned how to build a strong dividend portfolio, let's take it a step further with a powerful strategy that can supercharge your income. Investing in dividend growth stocks. These are special companies that don't just pay dividends, they increase them year after year. Imagine getting a raise every year just for holding on to your stocks. So what exactly are dividend growth stocks? These are companies with a proven track record of increasing their dividend payments consistently, often for decades. Why is this important? Because as the dividends grow, so does your income, without you having to invest any additional money. Over time, this can have a dramatic impact on your total returns. Take a company like Coca-Cola, for example. They've been increasing their dividends for over 58 years straight. If you had invested in Coca-Cola 20 years ago, your dividend income today would be more than double what it was back then, without buying a single additional share. This is the power of dividend growth. But how do you find these companies? A good place to start is with the Dividend Aristocrats. This is a list of companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. These businesses have weathered recessions, market downturns, and everything in between, all while continuing to reward their shareholders. Now, here's a little-known trick called the dividend growth snowball. It works like this. You reinvest the dividends from these growth stocks back into buying more shares. As the dividends increase and you buy more shares, the amount of dividends you receive also grows. It's like a snowball rolling down a hill, picking up more and more snow, getting bigger and bigger as it goes. The longer you let this process work, the faster your portfolio will grow. To give you an idea of the potential, let's look at an example. Say you invest $50,000 in a basket of dividend growth stocks with an average yield of 3% and an annual dividend growth rate of 8%. In 20 years, your initial investment could grow to over $250,000, and your annual dividend income could increase from $1,500 to over $15,000, just from reinvesting your dividends and letting the dividend growth do its work. But it's not just about picking any stock with a history of dividend increases. You want to focus on companies with a strong financial position, consistent earnings growth, and a commitment to returning value to shareholders. Companies in sectors like healthcare, consumer goods, and technology often have the stability and growth potential needed for this strategy. Here's what to look for when choosing dividend growth stocks. History of dividend increases. Look for companies that have increased their dividends for at least 10 years in a row. This shows they're committed to rewarding shareholders, even during tough times. Low payout ratio. A payout means the company is using less than 60% of its earnings to pay dividends, leaving plenty of room for growth and protection against financial setbacks. Strong free cash flow. Free cash flow is the money left over after a company pays for its operating expenses and capital expenditures. A healthy free cash flow indicates the company can easily cover its dividend payments and invest in future growth. Sustainable dividend growth rate. While high dividend growth is attractive, make sure it's sustainable. Companies that grow dividends too fast might struggle to maintain those increases over time. Solid balance sheet. Companies with low debt and strong cash reserves are better positioned to continue growing their dividends, even during economic downturns. Once you've identified the right stocks, the next step is to set up a dividend reinvestment plan, DRIP, if you haven't already. This will automatically reinvest your dividends into more shares, maximizing the compounding effect over time. Most brokerage accounts offer DRIP options, so it's easy to set up and manage. By incorporating dividend growth stocks into your portfolio, you're not just investing in a stable income stream, you're investing in your financial future. The combination of consistent dividend payments and steady growth can help you reach your income goals faster than with regular dividend stocks alone. I'm going to reveal a powerful strategy that takes dividend investing to a whole new level. It's a technique that combines the reliability of dividends with the growth potential of options, allowing you to boost your income even more. This is a game changer for anyone looking to maximize their returns, so stick around. You won't want to miss this. Now that you've built a strong dividend portfolio and added dividend growth stocks to accelerate your returns, let's take your strategy to the next level with a powerful technique that many investors overlook: covered call writing. This strategy allows you to generate even more income from your dividend stocks without selling them. It's a smart way to enhance your returns, especially if you're looking to boost your monthly cash flow. So what exactly is a covered call? In simple terms, it's a strategy where you sell someone the option to buy your stock at a specific price, known as the strike price, within a certain period of time. In exchange, you receive a premium, which is like an extra dividend on top of what you're already earning. It's a way of renting out your shares, earning extra income while still holding on to your investments. Here's how it works. Let's say you own 1,000 shares of a stable dividend-paying stock, like Microsoft. You're already earning dividends, but you want to increase your income. You decide to sell covered calls on those shares, offering someone else the option to buy them from you at, say, $350 per share within the next month. For this, you earn a premium of $2 per share, or $2,000 in total, just for giving them this option. If the stock price stays below $350, the option expires worthless, and you keep the premium, plus your shares, plus the dividends. If the stock price goes above $350, you may have to sell your shares at that price. While you might miss out on some additional gains, you still lock in a profit, plus the premium and dividends you've already received. It's a win-win situation as long as you're comfortable selling your shares at the agreed price. But why isn't everyone using this strategy? The truth is, most investors either don't know about it or think it's too complicated. But once you understand the basics, it's actually quite simple. And the best part? You can start small. Try writing covered calls on just a portion of your shares to get a feel for it. Let's go through a step-by-step checklist for implementing this strategy. Choose a stable dividend-paying stock. Look for companies with a strong history of paying dividends and relatively stable stock prices. Stocks like Microsoft, Johnson & Johnson, or AT&T are good candidates. Set a realistic strike price. Choose a strike price that's above the current market price but not too high. This should be a price where you'd be happy to sell your shares if the stock reaches that level. Understand the expiration date. Options expire on a specific date, usually monthly. Be sure you know when your option expires and what that means for your shares. Keep track of your trades. Record each covered call trade, including the strike price, premium received, and expiration date. This helps you understand the added income you're generating from this strategy. Consider your risk tolerance. Covered calls cap your potential gains at the strike price, so if the stock price surges, you could miss out on additional profits. Make sure you're okay with this trade-off before using this strategy. Covered calls aren't for everyone, but they can be a powerful tool for those looking to generate more income from their existing portfolio. By combining this with your dividend strategy, you're creating multiple income streams from the same investments, increasing your monthly cash flow without taking on significant additional risk. Now, I know this can sound a bit complex, but remember, you don't have to be an expert to get started. Begin with just a few covered call trades on a small portion of your portfolio. As you gain experience, you can expand your use of this strategy to enhance your returns further. To summarize, covered calls allow you to earn extra income by renting out your shares, boosting your cash flow beyond just dividends. It's a smart way to get more out of your investments while still holding on to the stocks you believe in. A complete guide to building a powerful dividend portfolio, maximizing your income with dividend growth stocks, and taking it to the next level with covered calls. By implementing these strategies, you can create a reliable, growing income stream that brings you closer to financial freedom. Remember, investing is a journey. It takes time, patience, and a willingness to learn. Start small, stay consistent, and watch your income grow. If you're ready to start your dividend investing journey, hit the subscribe button and ring the bell to get notified of my latest tips and strategies. And if you have any questions or want to share your own investing experiences, drop a comment below. I'd love to hear from you. Check out this video right here. You can change your wealth in just 6 months. Here's to your financial freedom. Happy investing.